Welcome to the Finance Abridged Digest for the week ending Friday, April 17th, 2026.
Glad to be here.
There is a specific mechanism by which quantum computing could break Bitcoin's encryption in a matter of minutes, driving its value to zero. We will break down the exact timeline physicist Chris Tam outlines for this threat and whether your digital portfolio is unknowingly exposed.
Yeah, it's a fundamental architecture level vulnerability. And, looking at the capital flowing into the space, retail investors are just relying on these institutional adoption narratives. They're totally blind to this cryptographic friction that could, pull the floor right out from under them.
Right, which is terrifying. And we are definitely going to unpack the underlying logic of that quantum threat later. But before we get to crypto, we need to frame what we are doing today in this deep dive.
Definitely. We've got a massive stack of source material today.
Exactly. I mean, transcripts, analytical briefs, expert interviews. Our mission is to basically synthesize the signal from the noise for you. Because if you are listening to this, you are an active investor.
Right. You're managing your own money.
Yeah, you have stocks, maybe a 401k, some commodities, crypto, and you're doing all this while, working a full-time career. You don't have 80 hours a week to stare at a terminal trying to parse out conflicting macro data.
Nobody does, honestly. And the data we're seeing suggests the underlying plumbing of the financial system is, it's shifting in ways that make the old 2010s playbooks mathematically dangerous today.
For sure. So the driving questions we are going to answer for you today are, what indicators should you be watching to know when to move? And what specific actions should you be ready to take in the next month?
That's the core mission right there.
Quick reminder, nothing in this show is financial advice.
Right.
We don't know your situation, your goals, or your risk tolerance. We're here to break down what the experts are saying so you can make your own informed decisions.
Absolutely.
Okay, let's unpack this. We have to start with the macroeconomic baseline. Because before we debate tech stocks or, copper supply chains, we have to look at the bedrock, which is the underlying cost of money.
Yeah, the foundation of the whole house.
Right. And according to the analytical brief, there is this massive disconnect between what the Federal Reserve thinks is happening and what is actually happening in the real economy.
Oh, it's a huge blind spot. I mean, Danielle DiMartino Booth frames this in incredibly stark terms in the sources. She essentially argues the Fed is ignoring the exact trigger for what she calls the biggest policy error in history.
The biggest policy error in history. I mean, that is a staggering phrase.
It is, yeah.
Let's get under the hood of that claim. Because if you just watch the algorithms on the headline news, you see the April payroll report, and it's flashing green, right?
Yeah.
Job creation looks robust. So what is the Fed supposedly missing?
Well, they're missing the actual math beneath those headlines. Booth points out that the Fed is making these generational policy decisions based on data that is just heavily distorted by statistical seasonal adjustment anomalies.
Okay, wait, I want to stop right there. Statistical seasonal adjustment anomalies.
Okay.
That sounds like the kind of academic jargon that just makes people tune out immediately.
Fair enough. Yeah, it's a mouthful.
But based on the brief, this is actually the sleight of hand hiding the true state of the labor market. How does this smoothing process actually work, and why is it failing right now?
So to understand the flaw, you have to look at how the Bureau of Labor Statistics actually counts jobs. They don't just call every business in real time. They rely on models, like the birth-death model, which estimates how many new businesses are opening versus closing.
Right, because they can't track every single mom-and-pop shop opening on a Tuesday.
Exactly. And on top of that, they apply seasonal smoothing algorithms. For decades, the labor market had very predictable rhythms, like retailers hire massively in November, and then they fire those same workers in January.
Sure, holiday rush.
Right. And construction ramps up in the spring and slows down in the winter. So the BLS applies mathematical formulas to smooth out those expected spikes and dips, so policymakers can see the actual underlying trend.
That makes logical sense, McGinn, in a normal world. You don't want the Fed panicking and slashing interest rates just because Macy's let their seasonal staff go.
Exactly. But Booth's argument is that the post-pandemic labor market fundamentally broke those historical rhythms. The structure of employment changed entirely.
How so? Like the gig economy stuff.
The gig economy, massive shifts in corporate hiring windows, and this huge influx of ghost job postings that stay open indefinitely but are never actually filled. The BLS is basically applying outdated 2018 smoothing models to a 2026 reality.
Oh, wow. So the algorithms are expecting a certain pattern of hiring, and when they don't see it, they just mathematically adjust the data upwards to fit what they expected?
That's the assertion, yeah. Booth argues these anomalies are creating a totally false narrative of economic strength. The headline number prints positive, algorithmic trading bots buy the news, and the Fed looks at their dashboard and says, hey, the economy is red hot.
We have to keep interest rates high to fight inflation.
Precisely. But beneath that artificially smoothed data, organic full-time hiring is actually stalling out.
It's like flying an airplane in a storm, but your altimeter is frozen at 30,000 feet. The pilot thinks everything is totally fine, but the ground is actually coming up fast.
That is exactly the risk, and it sets the stage for this massive policy error. If the Fed keeps the cost of capital aggressively high based on ghost data, they risk completely snapping the credit markets.
Which brings us to one of the most fascinating parts of the brief. Because there is a massive, explicit disagreement among the heavyweights about what happens when this reality finally breaks.
Yeah, this is a crucial tension to surface.
As an investor, you have to navigate this. On one side, we have Gromen. On the other side, we have Lyn Alden. And they are painting two completely different pictures of what happens next.
And you cannot position your portfolio for both scenarios simultaneously. They require entirely different defensive postures.
Right, so let's start with Gromen. He looks at this stalling underlying economy. He looks at the Fed relying on broken BLS data, and he sees a breaking point. What is the logic behind Gromen's view?
So Gromen argues that investors need to prepare for a sudden, aggressive deflationary shock. His logic is pretty straightforward. If the cost of capital stays highly restrictive, but corporate revenues and consumer spending are actually contracting, like Booth says, Eventually, a major gear in the financial machine just breaks.
Like what? What breaks?
It could be a regional banking sector freezing up, or the commercial real estate debt rollover failing, or corporate credit markets just entirely seizing up.
So a localized, violent credit event.
Yes, and when that happens, you get a rapid repricing of assets across the board. Equities plummet, credit spreads blow out. Gromen's takeaway for you, the individual investor, is that you must have significant cash liquidity on hand right now.
To survive the shock.
To survive it, yeah. And more importantly, you need cash to buy the ashes before the Federal Reserve inevitably panics, pivots, and floods the system with liquidity again.
Okay, so Gromen is basically saying, hoard cash, brace for impact, and wait for the glass to break.
Right.
But then we turn to Lyn Alden. And Alden is looking at the exact same macroeconomic landscape. But she argues that hoarding cash in anticipation of a shock is a massive mathematical error. Break down her counter-argument.
Alden zooms out. She's not just looking at private credit markets, she's looking at the sovereign level, the structural realities of the U.S. Treasury market. Her core argument is that the U.S. government is running multi-trillion-dollar fiscal deficits, and they have to continually issue trillions in new debt just to pay the interest on the old debt.
You're paying the Visa bill with the MasterCard.
On a sovereign scale, exactly.
Yeah.
And Alden points out this brutal math. Because the government must issue this debt regardless of economic conditions, the sheer volume of Treasury bonds flooding the market is historically unprecedented. So to subsidize this slow-motion debt rollover, the purchasing power of the underlying currency cash has to be quietly and permanently eroded.
Wait, so Alden is saying that inflation is essentially a feature, not a bug, of the current sovereign debt structure.
It's the only way the math works. You inflate the currency to shrink the real value of the debt. Therefore, Alden argues that holding a massive cash position while waiting for Gromen's credit shock means you are guaranteeing the destruction of your own purchasing power.
Because cash is just quietly bleeding to death to subsidize the national debt.
Exactly.
I really want to dig into this disagreement because it is the absolute crux of portfolio construction right now. If I am sitting at home looking at my brokerage account, trying to decide whether to move 20% into a money market fund, I am caught between these two titans.
It's a tough spot for an investor.
How do we evaluate the merits of each side without just, throwing our hands up?
You have to look at the difference between probability and certainty. Gromen's shock scenario, that deflationary credit freeze, is a probabilistic event. It's plausible, highly likely even, but it depends on specific psychological and market triggers that haven't happened yet.
Right, it's waiting for a domino to fall.
Exactly. But Alden's thesis is mathematically hardwired into the current congressional spending trajectory. There is no plausible legislative scenario where the U.S. government just stops issuing trillions in debt over the next 3 years.
So the erosion of cash is a mathematical certainty over a multi-year horizon.
Right. So Gromen is trying to time a highly probable car crash, while Alden is pointing out that the bridge we are all driving on is currently collapsing.
That is a brilliant way to frame it. So for the individual investor, the synthesis here is really about duration, isn't it?
Yes. Duration is everything. You cannot park your wealth in cash for the next 5 years expecting it to hold its value. The structural shift in fixed income is permanent. You might hold a small cash buffer for short-term optionality if Gromen's shock hits, but relying on cash as a safe haven is just a fundamental misunderstanding of sovereign debt dynamics.
Which brings us perfectly to how this dynamic directly hits the listener's wallet. We are not just talking about abstract government bond auctions. Justin Wolfers and Lyn Alden both point to permanent changes in global market structures caused by this dynamic.
Yeah, the supply of sovereign bonds is chronically overwhelming demand.
Let's apply this directly to the real economy. Because what does this global oversupply of government debt mean for a regular person who just wants to, say, buy a new house?
This is where macro theory absolutely collides with personal finance. The sources outline a phenomenon we can call the Treasury squeeze. To understand it, you have to look at how retail borrowing is actually priced. The cost of your consumer mortgage is not dictated directly by the Federal Reserve's overnight rate.
Wait, I need you to clarify that. Because everybody, myself included, assumes that when the Fed cuts rates, mortgage rates drop. Why are they severed?
Because your 30-year fixed-rate mortgage is priced at a premium above the 10-year Treasury yield. The 10-year Treasury is the benchmark. If the 10-year yield goes up, your mortgage rate goes up.
Okay, tracking so far.
Now, let's look at the supply and demand dynamic Alden highlighted. The government is issuing trillions in new 10-year bonds to fund the deficit. The supply is massive. But traditional buyers, like foreign central banks, are pulling back. So when you have a massive oversupply of bonds and shrinking demand, how do you attract buyers?
Well, you have to offer them a higher yield.
Yeah.
You have to pay them more interest to take on the risk.
Precisely. The sheer volume of government debt forces the yield on the 10-year Treasury to remain elevated, regardless of what the Fed does with short-term overnight rates.
Okay, let me use an analogy here because this is crucial. Think of the bond market like a massive highway system. The Federal Reserve controls the speed limit. That's a short-term overnight rate.
Good analogy, yeah.
But the long end of the bond market, the 10-year Treasury, is a 10-mile traffic jam caused by the government just dumping thousands of new debt onto the road every single day.
Right.
It does not matter if the Fed raises the speed limit to 100 miles an hour or drops it to 0. The traffic isn't moving. The congestion is structural.
That is exactly how it works. And the implications for the real estate market are profound. Let's say Gromen is right, and his deflationary credit shock hits tomorrow. The Fed panics, steps in, and slashes the short-term overnight rate to 0 to fight the recession.
Normally, that would mean cheap 3% mortgages for everyone again.
But not in this environment. Because the government is still running massive deficits, that 10-year Treasury yield remains choked. It stays elevated to attract buyers. Therefore, your baseline mortgage rate stays elevated. The sources are telling us that the era of the 3% fixed-rate mortgage is mathematically dead.
Wow. So even with zero interest rate policy at the short end, retail investors will still face 7% to 8% mortgage rates.
Exactly, because the long end of the curve is permanently clogged by sovereign debt.
And we're already seeing the devastating secondary effects of this. Ron Butler is cited in the brief warning that this exact underlying logic is causing a horror show in the housing market. It's a complete freeze.
It creates a massive misallocation of capital, and it destroys human mobility. If you bought a home a few years ago and locked in a 3% mortgage, you are wearing golden handcuffs.
Yeah, if you want to move for a new job or downsize for retirement, you have to sell, give up your 3% rate, and take on a new mortgage at 8%.
Which mathematically destroys your equity. Your monthly payment doubles for the exact same amount of house. So nobody moves, inventory evaporates, transaction volumes nationwide just stagnate.
The housing market ceases to function as a dynamic driver of the economy. It just becomes a frozen asset trap.
Exactly.
So let's pull all of this together for the listener. You are an investor. You are realizing that cash is guaranteed to erode. You realize long-duration sovereign bonds are toxic, and traditional real estate is frozen solid. So where do you deploy your capital over the next 3 to 6 months?
The analytical brief is incredibly clear here. When paper assets and fiat currencies are locked in a structural debasement cycle, capital inevitably flees toward physical scarcity. The sources suggest a major rotation into hard assets.
Which brings us to the physical realities of commodities and global supply chains. This is an incredible pivot. We are moving from the abstract math of bond yields to the very real logistics of moving heavy things around the globe.
Right? The real world.
Stephanie Pomboy's analysis in the brief focuses on geopolitical supply shocks. Specifically, the mechanical rerouting of global shipping away from the Strait of Hormuz. What are the cascade effects of that rerouting?
It is a massive, immediate injection of friction. When major shipping conglomerates decide the Strait of Hormuz or the Red Sea is too dangerous due to geopolitical conflicts, drone strikes, blockades, they don't just stop shipping. They reroute the vessels entirely around the continent of Africa, around the Cape of Good Hope.
Which adds, what, a few days to the journey?
No, it adds weeks. But it's not just the time. You're burning exponentially more bunker fuel. Maritime insurance premiums are skyrocketing because the risk profiles are elevated. But the most critical factor is vessel capacity.
Expand on that. What happens to capacity?
Think about the global fleet of shipping containers. There's a finite number of ships in metal boxes. If a journey that used to take 30 days now takes 45 days, that ship is tied up for an extra 2 weeks. It can't return to port to pick up the next load.
You are artificially shrinking the supply of available ships globally.
Exactly. You're choking the pipeline. And the result is a persistent spike in the cost of moving every single physical good across the ocean. The freight cost is just locked in higher.
And Pomboy makes the point here that I think is the most important takeaway of this section. This type of disruption locks in persistent supply-side inflation. And the kicker is central banks are completely powerless to stop it.
This is a vital concept for the amateur investor. We are taught that when inflation runs hot, the Fed raises interest rates to cool down demand.
Right. Make borrowing expensive, people buy less stuff, prices drop.
That works for demand-driven inflation. But, as Pomboy points out, you cannot solve supply-side friction with interest rates. The chairman of the Federal Reserve can raise the overnight rate to 15%, but that does not secure a safe passage through the Red Sea.
You can't print shipping lanes.
You cannot print cheaper maritime insurance. Destroying domestic demand does absolutely nothing to fix the geopolitical reality that ships are sailing thousands of extra miles. Therefore, this inflation is structural.
Okay, so the cost of simply moving things is structurally higher. But what about the underlying things themselves, the commodities? This is where Rick Rule's analysis of the physical copper market in the brief absolutely stopped me in my tracks.
Rule's analysis is brilliant.
Yeah.
He forces the investor to look past the financial screen and actually look at the geology. He breaks down 2 compounding variables that are breaking the copper supply chain. The first is what he calls a decade of capex deficits.
Capital expenditure. Let's walk through the history of this. Why did the mining industry just stop spending money on finding new copper?
It was driven entirely by Wall Street incentive structures over the last 10 years. Institutional shareholders and boards actively punished mining executives for spending capital on exploration.
Wait, really? They punished them for trying to find more product?
Yes. If a mining CEO stood up in 2018 and said, "We are going to sink $5 billion into the ground over the next 12 years to develop a new Tier 1 asset," the market would dump their stock. Shareholders demanded immediate returns, massive dividend yields, share buybacks.
They prioritized quarterly financial engineering over long-term physical reality.
Exactly. And the consequence is a catastrophic lack of new supply. You cannot just flip a switch and turn a copper mine on when demand spikes. Finding, permitting, and building a Tier 1 copper mine takes a decade. The industry simply did not do the work for the last 10 years.
But that is only the first variable. We don't have new mines coming online. What about the mines we already have? Rule highlights a second variable. Compounding grade depletion. Explain how that math works.
This is where geology fights back. Over the lifespan of a world-class mine, you naturally extract the highest quality ore first. As the mine ages, the grade of the rock degrades. 10 years ago, you might have mined ore that was 2% copper. Today, that same mine might be pulling up rock that is only 0.5% copper.
Meaning you have to dig up and crush 4 times as much physical dirt just to get the exact same single ton of refined copper.
Exactly. 4 times the diesel dump trucks, 4 times the electricity in the crushing mills, 4 times the manpower just to maintain a flat level of output. The cost of production skyrockets due to grade depletion alone.
So you have this perfect storm, a 10-year hole in infrastructure spending combined with existing supply becoming exponentially more expensive to extract. Meanwhile, the macro demand for copper EV grids, global electrification, AI data centers is surging.
The fundamental math simply does not work. You have accelerating demand colliding with a supply base mathematically constrained by geology and time. In a free market, when supply is physically incapable of rising to meet demand, there is only one release valve.
Price. The price has to act as a weapon.
Correct. Price appreciation is the only release valve. The price of copper has to rise so aggressively that it actively destroys marginal demand. It has to become so expensive that certain industries simply stop using it.
But wait, let me push back on this. If I'm listening to this, I'm connecting the dots back to our first segment. Booth said the economy is secretly stalling. Gromen predicts a deflationary credit shock. If we're heading into a brutal recession, won't the demand for copper just fall off a cliff? Why buy copper into a macroeconomic stall?
It's a totally valid challenge. That's how a traditional investor is trained to think. But Rule's underlying logic answers this perfectly. The structural supply deficit in copper is so deep, so historically unprecedented that it outweighs marginal macroeconomic demand destruction.
Yeah, walk me through the numbers on that.
Let's assume Gromen's recession hits hard and global copper demand drops by 5%. Normally, the price would plummet. But Rule's data suggests the supply side is structurally impaired by 10% or 15%.
Ah, I see.
Even in a recession, the market is still operating in a severe physical deficit. The pipeline is shrinking far faster than the water flow is dropping. Therefore, it is a supply crisis, not a demand boom.
Okay, that makes complete sense. The scarcity outpaces the slowdown. So what does this mean for the listener's portfolio? The actionable insight here is that over the next 3 to 6 months, you should consider moving capital toward physical, hard assets. Specifically, industrial metals like copper and monetary metals like gold.
Which presents a fascinating dichotomy, because while commodities are grounded in harsh physical realities, the source material explicitly warns that traditional equity markets are completely divorced from reality.
Right, they are operating on an algorithmic illusion. Let's transition into that, because if capital's fleeing bonds, a lot of retail investors just default to the stock market. But the brief outlines a terrifying scenario regarding equity market fragility. We were talking about the V-shaped illusion.
Ted Oakley is the primary source here, and he outlines a mechanical trap that is currently fully set in the mega-cap tech sector. This directly threatens the retirement accounts of almost everyone listening.
Let's spend some real time on this. What is Oakley's trap?
Oakley breaks down a 5-step unwinding process. Step 1 is psychological conditioning. For over a decade, we existed in a zero interest rate policy environment, ZIRP. During that era, retail investors were subjected to this Pavlovian conditioning experiment.
Every time the stock market experienced a correction, the Fed stepped in, flooded the system with liquidity, and the market bounced back in a sharp V-shape.
Exactly. The lesson branded into every retail investor was buy the dip. No matter what, if the line goes down, buy it because the Fed will rescue it. Which leads to step 2, how that capital is deployed. Retail investors aren't doing deep discounted cash flow analysis on individual companies.
No, the 401k deduction comes out of your paycheck, goes into Vanguard, and automatically buys the S&P 500 index.
But the architecture of that index is the crucial flaw. It is market cap weighted. That means the largest companies receive the vast majority of every incoming dollar. When you buy the S&P 500 today, that new capital disproportionately bids up the top 5 or 7 mega cap tech stocks, completely regardless of valuation.
It's a self-fulfilling feedback loop. They act like a black hole sucking in passive capital.
Which triggers step 3. This is the trap. Corporate insiders and institutional funds look at the valuations of these mega cap tech stocks and realize they have detached from physical reality. So what do? They use this blind retail buying as exit liquidity.
Meaning they are quietly selling their shares to you.
Yes, they are locking in generational wealth by handing the overpriced bags to passive indexers who are blindly buying every 2 weeks.
That is wild. It's an invisible wealth transfer. But what causes the music to stop? What is step 4?
The trigger. Because these stocks have absorbed so much capital, their valuation multiples are priced for absolute perfection. They're trading at 30, 40, 50 times forward earnings. The algorithmic models assume exponential growth forever. So in an environment priced for perfection, any marginal deceleration in forward guidance shatters the model.
The company doesn't even have to lose money.
No, they can still be generating billions in profit, but if they announce growth is slowing from 25% down to 18%, the algorithms panic, which leads to step 5, the collapse. Oakley calls it violent multiple compression.
I really want to pause and explain multiple compression because it is so misunderstood. People think a stock only crashes if the company goes bankrupt. That's not true, is it?
Not at all. Let's use a math example. Say a tech company generates $10 a share in profit. Because of AI hype, investors pay 50 times those earnings to own the stock, so it trades at $500.
A price to earnings ratio of 50.
Correct. Now, the trigger event happens. The company announces slightly slower growth. The underlying earnings don't drop, they still make $10 a share. But the psychology shifts. Investors decide they are no longer willing to pay 50 times earnings. They decide fair value is only 20 times earnings.
So you take that same $10 profit, multiply it by the new PE ratio of 20, and the stock is suddenly trading at $200.
Precisely. The stock collapses by 60%, devastating retail investors who bought the top, even though the company is wildly profitable. That is multiple compression. It destroys wealth through the repricing of sentiment.
And because retail investors expect a V-shaped recovery, they hold on to the bleeding asset, assuming the Fed will rescue them. But in Alden's structural inflation environment, the Fed cannot print their way out of a valuation bubble without destroying the currency.
Exactly. And it isn't just Oakley sounding the alarm. Chris Vermeulen looks at the technical architecture and maps what he calls the failure of market breadth.
Vermeulen's data is fascinating because it proves how the headline indices mask internal rot. The nightly news says the S&P 500 is hitting all-time highs. But what's actually happening beneath the surface?
Beneath the surface, the vast majority of the other 495 companies are already rolling over. Vermeulen identifies a structural stage 4 distribution phase. The average stock is in a downtrend, struggling with high capital costs. But the passive investor doesn't see it because the index is propped up by 5 giants.
Jan Van Eck chimed in with a great point about this. He talked about how corporate boards have to legally sign off on net asset value, or NAV. Explain how NAV works and why his point is so alarming.
NAV is the fundamental accounting reality. You take everything the company owns, cash, real estate, patents, and subtract what it owes. That is the actual physical value. Van Eck points out the massive widening chasm between the NAV that boards legally sign off on and the astronomical price the stock market assigns to the company.
So the financial representation completely divorces from physical value.
Yes. When that happens, you are in the terminal stages of a speculative frenzy.
Bring this back to the listener. You've been told your whole life that diversification is the safe haven. You buy a broad index fund, own 500 companies, and you're protected. What does Oakley's trap mean for that strategy?
The sources are warning that 401k diversification is a myth right now. Because the S&P 500 is cap-weighted, buying that index mechanically drops roughly a third of your life savings into just a handful of tech stocks.
You think you're buying the American economy, but you're taking a massive leveraged bet on 5 tech CEOs.
Yes. And if Oakley and Vermeulen are right, when multiple compression triggers, a 30% or 40% drawdown in those specific mega caps will mathematically drag your entire index fund down. The gravitational pull of the tech giants collapsing will destroy years of wealth.
The actionable takeaway here is stark. Over the next 30 days, investors should critically evaluate their passive index funds and consider reducing mega cap tech exposure. You have to recognize the dot-com style bubble risk,
which naturally drives capital to search for alternative stores of value. When bonds are broken and equities are a trap, retail investors turn to digital assets.
Which brings us to the final, most volatile section, the crypto dichotomy. We have to deliver on the hook from the beginning regarding the quantum threat to Bitcoin. But first, the sources reveal a hidden friction in digital assets that retail investors misunderstand.
It is imperative to establish a guardrail here. You must separate two completely different phenomena: the structural debasement thesis versus speculative trading behavior.
Let's draw a hard line. Start with the structural debasement thesis. This is the macroeconomic reason crypto has value, right?
Correct. Raoul Pal outlines this. Pal discusses institutional adoption spot ETFs, major wirehouses allocating client funds, Bitcoin being legitimized in sovereign wealth funds.
And the logic connects directly back to Lyn Alden's point about sovereign debt.
Exactly. If fiat debasement is a mathematical certainty, institutions need a decentralized, immutable ledger of value that a central bank cannot inflate away. That's the macro hedge.
But, and this is a massive, but you cannot confuse that long-term adoption with how the asset trades on a Tuesday afternoon.
Precisely. Speculative trading behavior is driven by extreme leverage, algorithmic momentum, and violent technical liquidations in the derivatives market.
And beneath both of those realities lies a foundational technological risk. Physicist Chris Tam outlines a specific mechanism where quantum computing could break Bitcoin's encryption entirely. We're talking about the value gapping to absolute zero in minutes.
To understand this, we have to look at cryptography. Traditional encryption, specifically elliptic curve cryptography used by Bitcoin, relies on the mathematical difficulty of factoring impossibly large prime numbers.
Let's make this concrete. If I take two massive prime numbers and multiply them, a computer does it in a millisecond. But if I give a computer the resulting number and ask it to find the two original primes,
it's incredibly difficult. It's a one-way mathematical function. A traditional supercomputer would have to try every single combination one by one. It would take longer than the lifespan of the physical universe to crack a single wallet.
It's a digital vault with a combination lock that has trillions of digits. So what changes with quantum computing?
Quantum computers use qubits. Due to quantum superposition, a qubit can exist in multiple states simultaneously. It isn't just a 1 or a 0, it can be both at once. Tam points out that using Shor's algorithm, a quantum computer can exploit this superposition to solve prime factorization exponentially faster.
It effectively evaluates all possible combinations of the lock simultaneously.
Yes, and it collapses onto the correct answer.
That is mind-bending. But what does it actually mean for a Bitcoin wallet?
In Bitcoin, your public key, your wallet address, is visible to everyone on the blockchain. Your private key allows you to spend the funds. Currently, it's impossible to mathematically derive the private key from the public key. But Tam warns that a sufficiently powerful quantum computer could run Shor's algorithm against the public ledger.
They could retroactively calculate the private keys for every visible wallet.
Yes, and instantly drain the funds. But the primary problem is systemic trust. Bitcoin has value because the ledger is cryptographically immutable. The moment the underlying encryption is broken by a quantum machine, the trust mechanism evaporates.
And without trust, the asset has no value. Institutional capital would flee in seconds. The price would gap down to absolute zero.
Exactly.
But even if we put the quantum threat on the shelf as a future black swan, there is a much more immediate structural risk. Let's look at Lyn Alden's analysis of Bitcoin miner capitulation.
This is a perfect example of speculative trading risk. Miners operate industrial-scale server farms with massive fiat fixed costs: electricity, cooling, maintenance. But their revenue is paid entirely in Bitcoin.
So what happens when the fiat price of Bitcoin drops below their baseline cost of production, or a halving event cuts their revenue?
The marginal miners bleed cash. They capitulate. They are forced to aggressively liquidate their Bitcoin reserves onto the open market just to avoid bankruptcy. This forced selling drives the spot price down further,
which sets off a chain reaction. Highly leveraged retail traders hit margin calls, their positions are liquidated by exchanges, driving the price down again.
It creates a structural liquidation cascade, and this happens completely independently of the macroeconomic news cycle. The Fed could be cutting rates, but if the mining network plumbing breaks, you see a violent 30% to 40% drawdown over a weekend.
So how does this hit your wallet? Let me use an analogy. Holding a spot Bitcoin ETF is like holding a paper receipt for a digital vault. You absorb absolutely all of the price volatility and structural risk, but you don't actually hold the cryptographic keys.
That is the crux of the trap. When you allocate 5% of your 401k to a crypto ETF based on Pal's adoption thesis, you are unknowingly assuming Tam's binary quantum risk. You're holding a paper claim that will vaporize if the cryptography is broken.
Furthermore, if Alden's minor capitulation cascade hits and the ETF ticker violently drops 30% in 3 days, retail investors react with standard equity-style panic.
Mathematically, they panic sell at the exact bottom of the structural liquidation cascade. They become the exit liquidity for the structural washouts.
We have covered an immense amount of ground today. The broken BLS data, the sovereign debt trap, the Treasury squeeze, the copper capex void, the algorithmic index trap, and quantum crypto risks. We need to synthesize this. What is the actual timeline of action for the serious amateur investor?
Based on the brief, we can distill this into 3 distinct temporal horizons. First, the next 30 days. Watch for multiple compression in equities. Critically evaluate your portfolio and consider reducing exposure to passive, cap-weighted mega-cap tech funds. Don't serve as exit liquidity.
Got it. What about the intermediate term?
That's 3 to 6 months. Watch global shipping data and mining capital expenditure deficits. Consider allocating capital toward physical hard assets like copper and gold to hedge against supply chain disruptions and structural deficits.
And the long-term horizon?
Multi-year. Accept the permanent structural shift in the sovereign bond market. Avoid long-duration government debt. Acknowledge that your cash will quietly erode, and accept that the era of the 3% retail mortgage is mathematically dead.
As always, this is analysis, not advice. Talk to a qualified professional before making changes to your portfolio. But I want to leave you with one final provocative thought. Joanne Hsu noted something deeply chilling in the source material regarding mass psychology. She pointed out that consumer sentiment right now is actually worse than it was during the depths of the 2008 financial crisis.
Which is incredible.
But the terrifying part is that this sentiment is being driven heavily by algorithmic news feeds designed to maximize engagement by inducing constant anxiety. So here's the question you have to ask yourself. If algorithms have already successfully convinced the public that we are living through a massive depression while the stock indices are at all-time highs, what happens to mass psychology and your algorithmic newsfeed when Oakley's multiple compression event actually triggers, the megacaps break, and a real panic sets in?
Something to think about for sure.
Thanks for joining us on this deep dive. See you next week.